Kia ora, and welcome to the otality Property Market Update for Haratua, May 2025, brought to you by Loan Market. Aotearoa property values continue to increase in April at a relatively modest rate of 0.3%. This takes the median value to almost $820,000, a 0.9% increase over the past 3 months, but still 16% below the post-COVID peak of $974,000. As is often the case in early stages of the recovery phase, there remains inconsistency across the country. This is highlighted by quarterly growth of 2.1% in both Kirikiriroa Hamilton and Otautahi Christchurch, balanced with minor declines in Tauranga, down 0.4% over the past 3 months, and Otipoti Dunedin edging 0.1% lower since the end of January. Meanwhile, property values in Tahuna, Queenstown Lakes region, have shown some recent vulnerability, falling 1.5% over the last 3 months. Though it should be noted a more long-term resilience to the downturn sees values still 1.3% higher than the same time last year. Other notable results from across the main urban areas include 2.1% growth in Ahuriri Napier values over the last 3 months, followed by Kapiti Coast and Whangarei values increasing by 1.7% over the same period. In Whakatu Nelson, values are down 1.1% since the end of January, while Hiri-Taonga, Hastings, Te Papa Ioia, Palmerston North, and Te Awa Kairangi Ki Uta, Upper Hutt, all saw values decline by 0.5%. This variability will likely continue for a while, month to month and region to region, as localised fundamentals vary in their scale and impact. Supply in the form of total listings on the market and demand stemming from the confidence in local labour markets, as well as affordability calculations, are shaping up differently around the country, and this will affect short to medium term market trends. The flow of new listings in April was affected by the back-to-back long weekends of Easter and Anzac holidays, with 14% fewer properties taken to market than April last year. When combined with sales transactions continuing to tick along, this has led to total volume of listings sitting 1% below the same time in 2024. But while the year-on-year comparison is comparable, supply remains high in a more historic context, and the power very firmly remains with buyers, though it should be noted there are regional differences. In Otako, Otago, and Tairāwhiti Gisborne district, there are 15% and 13% respectively more properties for sale today than a year ago, while in Tamaki Makaurau, Auckland, and Te Tauihu o Te Waka o Maui, the Upper South Island region, there are at least 6% fewer properties for sale. This is not necessarily a huge difference, and once again the longer-term comparison illustrates buyer choice as healthy, but there are early signs of a rebalancing of supply, which could lead to a shift of power come the end of winter. Buyer activity is also location dependent. At a nationwide level, mortgage multiple property owners' share of purchases continues to trend upwards, hitting 24% in April, their greatest share since October 2021, as lower interest rates improve yields, and more favourable regulations such as interest cost deductibility and a shortened bright line test entice investors, particularly those with a total of fewer than 5 properties, back into the market. First home buyers haven't shied away from the market either. They secured 26.7% of property sales in April, a notable bounce back after their market share had dipped earlier this year. Looking regionally, however, there are some distinct patterns. Waira Te Whanganui Atara, Wellington, has always been a first home buyer dominated market, but the record 47% of Te Awa Kairangi Ki Tai, Lower Hutt sales for this group in April, illustrates that demand remains strong and entry-level properties are available. Further south in Otautahi Christchurch, where properties are more affordable and rental yield is often higher, mortgage multiple property owners picked up a record 29.1% of purchases in April, still contained high debt-to-income lending for both investors and first-home buyers, illustrates there remains a level of caution on the market, with borrowers unwilling to maximise their debt exposure, perhaps mindful property hasn't been a one-way bet lately, and reflective of the struggling economy and vulnerable labour market. Speaking of, there was a pleasant surprise in the release of the labour market figures for Q1, with the unemployment rate staying stable at 5.1%. Though reduced labour force participation shows all is not well, and reduced wage growth is not a great news story either. That is, other than when it comes to inflation indicators. And while we saw an out-of-cycle revision to annual CPI inflation for Q1 from 2.5% to 2.6%, it isn't expected to halt the Reserve Bank's likely decision to cut the official cash rate a further 25 basis points to 3.25% at the end of May. The forward guidance on the OCR will be of real interest when they publish the full monetary policy statement, but with the disruption and uncertainty over tariffs appearing to soften, perhaps the changes won't be as great as expected a month or so ago. The global trade situation is an ever-changing landscape, and global economic growth is still likely to suffer, which should see the terminal or neutral OCR forecast drop below 3%. As we've seen lately though, things can change quickly, so make sure you stay on top of all our reports and releases by following us on the Otality NZ social channels and subscribe to the New Zealand Property Market Podcast on all good podcast players. While the brand may have now changed from CoreLogic to Otality, we continue to publish New Zealand's leading housing market insights and metrics. For now, these are still available on the news and research pages of the CoreLogic NZ website. Mā te wā.